This video is going to look at negative beta stocks and at portfolio betas. Here we have Bankruptcy Auction Services, which has a negative beta of negative 0.3. In other words, when the market goes up, BAS goes down. When the market goes down, BAS stock goes up. We'll look at how this stock's required return compares to the risk-free rate, assuming that the risk-free rate is 4% and the market risk premium, R sub M, the return on the market, minus the risk-free rate is 6%. So R sub M minus R sub F is 6%. Because the expected return on the market is higher than the risk-free rate, in other words, we've got a positive market risk premium, that implies that the expected return of bankruptcy auction services is going to be below the risk-free rate. As long as the market risk premium is positive, which means that people demand a higher return for investing in the market than they do for a risk-free investment, then the second term in the capital asset pricing model is going to have to be negative if the beta is negative. Let's look at this and see again what implications this is going to have. The capital asset pricing model states that required return is equal to the risk-free rate plus beta times the return on the market minus the risk-free rate. Well, in this case, we're given that we've got a risk-free rate of 4%, we have beta of negative 0.3%, and we have a market risk premium of 6%. Plugging those numbers into a calculator, we get an answer of 2.2%. Well, this is indeed lower than the risk-free rate. The risk-free rate is 4%. And we now have a risky asset that returns less than the risk-free asset. That seems kind of strange. Why would investors be willing to accept a 2.2% return when they could play it safe and invest in Treasury securities that earn 4%? The answer is that a savvy investor is not going to hold bankruptcy auction services alone. Instead, the investor is going to hold it in combination with other securities as part of a well-diversified portfolio. These other securities will tend to rise and fall with the overall market, but because BAS has a negative beta, its correlation with the market is negative, which means that BAS tends to perform well when the rest of the market is doing badly. So by holding bankruptcy auction services, an investor can reduce overall market risk of the portfolio. So this is like recession insurance for a portfolio. And investors are going to pay for this insurance by accepting a lower return. Next, let's look at portfolio betas. The beta of a portfolio is the weighted average of each of the betas of the assets within that portfolio. Here's an example. We've got 4 companies, DoubleClick, Coca-Cola, Intel, and ATI. We have the weights of each of these securities in the portfolio, and we have the betas of each of these stocks. These are all risky companies, tech companies, internet companies, with the exception of Coca-Cola, which has a very low beta, very low market risk. So we're combining some very high-risk stocks with some low-risk stocks. And the important answer that we want is, what is the portfolio beta under these circumstances? To calculate the portfolio beta, we're going to use the weights that we've been given, and we're going to use the betas, and again we want a simple weighted average. So portfolio beta is going to be equal to the weight of stock 1 times the beta of stock 1 plus the weight of stock 2 times the beta of stock 2, and so on. So in this particular case, the portfolio beta is going to be the weight of DoubleClick. We have a 0.133, 13.3% weight of DoubleClick and a 2.685 beta. The weight of Coca-Cola, we have a 0.2, 20% in Coca-Cola, and a 0.195 beta. We have a weight of Intel of 0.267 and a beta of Intel of 2.161. And we have a weight of ATI of 0.4, 40%, and a beta of 2.434. And overall, our portfolio beta is 1.947. So again, it is lower than the highest beta and higher than the lowest beta.